We are live, and as you guys are joining in, why don't you guys let us know in the chat where you're calling in from and how many deals you guys have done so far. With us today, we've got a very special guest. I'm David from DealMachine, and we've got Brad, head of content at Stessa, and we've got Victor with Stessa as well. And I'm trying to see, did our third guest join us yet? Nope, we've got Matt from DealMachine and AJ, who's head of customer support at DealMachine as well. So what's up, Matt? Matt Gambino, where are you calling in from? As you guys are joining in, let us know in the chat where you're calling in from and how many deals you guys have done so far. Awesome that you're from New Jersey, Matt. Hey, Dwayne. All right, we got Tally from Prescott, Arizona. Constance, we've got Dwayne from Virginia Beach, and Janika from Maryland, still working on that first deal. Somebody from Dallas, and let's see here, Norfolk, Virginia, Charlotte, Texas, 3 deals. And we got Alan from San Francisco, Bob from Jacksonville, 3 deals. Jacob from North Carolina, and let's see, Matrice working on that 3rd deal, Bellevue, Washington. That's pretty close to Canada, where Brad's at. Well, actually, where is Ottawa? I'm gonna make sure I get my Canadian geography right.
It's about in the middle somewhere.
Okay, northern speaking, it's close. All right, we got Angela from Houston, Texas. All right, from ATL, dirty Jersey, loving it. Okay, so we've put this webinar together for you guys because we want to make sure you know about some of the latest tech advancements that can help you land and maximize your rental revenue. So for those of you guys who might know me as the CEO of DealMachine, I started out first as a rental property investor. Back in 2017 is when I did my very first deal. I was inspired by Rich Dad, Poor Dad. I read that book and I played the cash flow game. Hi, Jalen. And one thing I noticed was it was really important that you buy your property right so that it cash flows. And my first deal was in 2017. I ended up building DealMachine to help me acquire more deals with the process that I was using to find deals, driving for dollars and looking for deals on the MLS. Now I have 10 rental properties, and man, I'll tell you what, after adding like 2 or 3, it kind of is hard to keep track of what is being paid here, what expenses are there. But I found out about Stessa, and so I've been using Stessa to manage my rental portfolio and grow it and keep track of its value and appreciation and all of that good stuff. And so I'm truly honored to have with us the Stessa team, and Brad is going to be my co-host on this webinar. And he is an expert on everything rental finance and the tech that powers Stessa to do that. So let me introduce you to Brad and have him tell you a little bit about his background.
Well, thanks a lot, David. Really appreciate it. Thanks, everyone. Thanks for joining. I'm really excited to be presenting here with you all. Like David said, my name is Brad Cartier. I'm really lucky. I'm fortunate enough to be able to write content for a few real estate platforms like Stessa and Motley Fool. But at the end of the day, I'm a real estate investor. Like David, I got my start after reading Rich Dad, Poor Dad. Bought my first rental property in 2013. It was a condo that we purchased in a suburb of Ottawa, and have caught the bug since then, and graduated to new development condos, single family homes, now doing small missing middle multifamily acquisitions, as well as multifamily developments in the Ottawa and Montreal areas. So we're up to 40 doors now, and don't plan on stopping. So I like many people on this webinar, know and understand the need for technology, and with with everything going on and all the innovation going on, sometimes it can be a little overwhelming. So I'm really excited to sort of cut through that today and give you guys all some actionable steps that you can take to really optimize your portfolios.
I'm excited to learn from you too, Brad, because 40 doors is a whole different ballgame than 10 where I'm at. It's really awesome that you're here. And guys, Brad and I have teamed up tonight to show you what we've learned along the way in acquiring deals and building our portfolio and managing it, so that you guys can learn for yourself what's important before tossing more money into the ring yourselves on your investing journey. Cool. So phase one, research. You want to make sure you do all the necessary due diligence before your money gets involved. One example that this reminded me of when we were creating this slide was about the third deal that I did, I actually had a signed offer for $45,000. And during the due diligence process, I actually discovered that it was going to cost $10,000 extra to repaint this house because they were a heavy smoker and that smoke couldn't be covered up with paint. It was actually going to require a ton of extra labor and materials to get rid of that. So that's just one example of, because I caught that in the due diligence, I could come back to the seller, present that fact to him, and buy the deal $10,000 cheaper to make sure that I could still turn a profit and not lose money. So that's what this section is all about, is researching and doing due diligence. So there's a couple of quick rules of thumb. There will be a recording available, Brock. Thank you for asking. So you've got to determine that ballpark return on investment before you ever figure out what you should be buying the property for. And some of the important rules of thumb for me that I kept hearing all the time was the 2% rule and the 1% rule. Now I'm curious, does anyone here know what the 1% rule is? If you do, would love for you to type it out real quick in the chat. We'll come back to it. The second bullet point is confirming the property is taxed appropriately. So I was just evaluating this 10-unit building off Allisonville Road here in Indianapolis, and they've got it listed for I think $1.2 million. And when I was looking at their pro forma, the tax assessment still is like $100,000. So they like totally re-renovated this thing, and it's probably due to have a big tax increase. And so if I'm buying it, I need to factor in that my expenses are going to be 10x whatever the current tax liability currently is. So we actually didn't do a deal because I didn't want to buy it at the price he wanted, because I knew my expenses would be higher than what they were showing on their pro forma. So that is another example that kind of struck a chord with me. Christine from Jersey, I believe, has an answer to the rules of thumb, so I'm going to read it. Christine says that the rent should be 1% of the purchase price, and that is absolutely right. So that's one of the things I follow in my own investing before I ever spend any more time doing due diligence, because due diligence takes a while. If you can find some shortcuts to quickly dismiss deals that probably aren't worth your time, the 1% rule is how I do that. So if I'm buying a house for $100,000, I need to make sure that it can rent for $1,000. And the way that I could confirm that is if it's currently being rented. Oh no, did my camera freeze on you guys?
Yep. All right.
Okay. All right, cool. Yeah. So if
maybe turn it off and back on, David. Yeah.
I'm gonna give that a shot here.
It's a great face though.
When it's Brad's turn. So yeah, if it's currently being rented for $1,000, that's my verification. But I also love to plug in the address and rentometer and just see that, maybe market rents in the area for a similar house would be $1,000 to meet that 1% rule. If on the other hand, I'm seeing it's only $700, that would not be 1% of the purchase price. And so that would not meet the 1% rule. So I probably wouldn't pull the trigger on a rental that doesn't meet the 1% rule. probably wouldn't look any further into it. And then that third bullet point is how I started my own portfolio. And it was back in 2017. I was looking for a bunch of houses that were rentals, and I was getting a little bit overwhelmed with like, what if this goes wrong? What if that goes wrong? And I was living into an apartment at the time, and I was like, hey, wait a minute. Why don't I just buy a primary house, get a better deal on my loan, and rent out 4 of the bedrooms, which is called house hacking. And so that's exactly what I did. I got this 5-bedroom house for $200,000. It took a lot of the hesitation I had off about having an asset, having a rental property, because it was just like, well, I need a place to live. Might as well just buy one myself and rent out some of the bedrooms. So I realized that may not be possible if you're married or if you have kids, but for me, that's how I got my start. All right, Matt, you go to the next slide. I'm going to give this camera a shot here.
Thanks for that, David. So yeah, I love, just as an aside, I love the 1% rule. It also depends on its, market specific conditions. I'm up in Canada, and real estate tends to be a little bit higher priced here. Like the average home price in Ottawa is, I think the last one was about 700,000 Canadian dollars. So that's probably about 550 USD, 500 USD. So the 1% rule doesn't really make sense up here. It's more like the 3 or 4% rule, but you just gotta look at your market and adjust accordingly. And I love house hacking. That's, any beginner investor, that's the first questions I'm asking to see if house hacking will work for them, because that's such a great model to get into real estate investing. So in the Q&A, if anyone has any questions about that, we can talk about it a bit more. I have 4 kids now, so can't really house hack these days, but if I were younger, I would be in on that. Okay, you're back, David. Nice to see you. So let's talk a bit about metrics. And I know it sounds silly to say, know your metrics and all that kind of stuff, but I see this time and time again, mostly with beginner investors. But I saw a lot of people here are first-time investors or looking to get their start. If you can master just a couple simple metrics, you'll be well ahead of most investors, even intermediate ones that I talk to, and some advanced ones who get metrics mixed up or don't really understand what they mean. So you have to learn your metrics. So I'll get off my soapbox and talk about a few key ones here. First one is cash flow. And cash flow, the interesting thing about cash flow, it's less of an investing metric and more of a sign of how well your business is or isn't doing. It's your net cash left at the end of the month after you've received all your rents, paid all your expenses. If you rent a building for $2,000 a month, all your costs are $1,200, then your net cash flow is $800. So here you will include your debt servicing and taxes in this calculation, unlike your net operating income calculation, which we are going to get into. It's cash flow is really just a representation of money in and money out of your bank account each month. It's a really important number because obviously if it's negative, then you won't be able to pay your bills at the end of the day and make a profit. Negative cash flow, it can also be an indication of that you're spending too much money on the property, and you should examine your expenses. Or you may have a delinquent tenant who's late, partial payments, all that kind of stuff can eat into your cash flow. And during the research phase, like doing cash flow assessments, it's very simple, but people often overlook it. You have to know that the market rent that you're going to get for that property is going to cover all your expenses and a little bit more. And we can get into a little bit more about what a good cash flow is, and it really depends on the property, because cash flow doesn't really tell a story. It just tells you how much money is in your bank account at the end of the month. So
Brad, I have a question for you.
Yeah, go for it.
So I was interested in what you had to say about the 1% rule. Actually, you said in Canada, your market has different characteristics than mine, and so you didn't follow that rule. Is there a rule? Do you call it like the 0.5% rule, or do you just kind of totally look at all these other metrics?
Yeah, I focus on all these other metrics, mostly cash flow and cash on cash return, which we'll get into later. That's okay. A bit more on the optimization phase of it, but for sure in most Canadian markets and some markets in the US as well, like some of the major metros, the 1% rule is very challenging to adhere to.
Yeah, it's hard here. So I imagine it's hard a lot of places.
Yeah. All right, so NOI, net operating income. So the NOI tells you how much money you make from a given investment property on a monthly, or typically you use it on a yearly basis. So a good way to think about NOI is it's a high level income statement for your rental property. Some investors tell me that this is the most important metric in their investing business. I would tend to agree, because it has a direct impact on your cash flow if you're investing in single family homes or condos. And it will even dictate the value of your property when you get into multifamily and commercial real estate. And that's the game I play in, and everything revolves around your net operating income, and that will have an impact on what the bank says your property is valued at. So the good news is it's super easy to figure out. So to calculate it, you take your total income and you subtract all your operating expenses, and you will never include your mortgage payments or taxes in the NOI calculation, because those are not technically considered operating expenses. So all of your yearly operating expenses, like, insurance, property management, utilities, all these recurring expenses are included in the NOI calculation. No large Capex expenses in that, and just because those are one-time costs. And they'll use the net operating income to judge a building's ability to generate revenue or profit.
Ooh, this is going to be good, because I have like a lot of my CapEx showing in my net operating income in Stessa. So I'm wondering if I could tweak that so it's not included.
Yes, and we'll see that later with Victor and Devin. All right, moving on to stress testing. I love the stress testing. In my mind, there are three main threats to an investor's portfolio. And I mean, now more than ever, this is super important. I don't need to explain what happened over the last 12 months. That 5-letter word, it's been challenging for everyone, not just real estate investors. So you have to upfront during your research phase, stress test your investments. And I do this in my pro forma. So I have three main threats that I look at. Number one is vacancy. Number two is increased interest rates. And number three is large capital expenditures. So vacancy, what if you're 10% vacant? How does your cash flow look then? 20% vacant. If you have a duplex and one person leaves, you're technically 50% vacant. Can your asset withstand that kind of vacancy? Increased interest rates. We've had historically low interest rates. They dipped above 3%, but then just dipped below back 3%. So who knows what's going to happen with all the economic stimulus spending happening. But at the end of the day, you need to be prepared to withstand a interest rate hike or a shock to your portfolio if interest rates do go up. And large capital expenditures. I mean, if you all of a sudden have to spend $10,000 to repaint a smoker's house that was in there for 5 years and smoked every day, then that's gonna eat away at your bottom line.
I have a question about the interest rates.
Yes, sir.
So I've noticed it's harder for me to rent my properties in 2021. And I feel like it's because the interest rates went, I don't know if it was up or down, but it's like really great loans right now. It seems like more people are buying homes than trying to rent my properties right now. Is that how it's affecting you too? Or do you guys actually have like a variable rate loan?
I always go variable. In Canada, it's about 85% of the time it tends to be better than a fixed rate.
Okay.
It depends on your market. What we're seeing here and what we're seeing in a lot of major markets in the US is that because price appreciation has been accompanying low interest rates, you're not really seeing affordability is just as challenging, even though money is cheap. So it really depends on the market. Like in Canada, for instance, it's never been easier for me to fill up rentals, even though the last interest rate I got was a 1.7% interest rate. So it's technically easier for people to borrow money, but asset prices are so elevated that it's just way more expensive. So they need a bigger down payment. So it just depends.
Got it.
Good question though. Last point on this slide is financial requirements. This goes without saying, but you need to be liquid enough to acquire the property you're analyzing. So, do you need the typical 20% down payment? Maybe it's 25, maybe it's 30. So you really need to talk with your broker or your banker beforehand to make sure that you have the liquid capital to acquire this asset. Do you require a rental budget? Again, like David, your example of, do you have that extra $10,000 to throw into the property cash? Maybe you can't, maybe you can roll in the rental budget into the loan. Maybe you can't. You need to know that if your rental budget is going to be $60,000 and you have to pay that out of pocket, that makes a big difference. Are you bringing in capital partners? Are they ready to write you a check, or are they just sort of thinking about it? You need to make sure the capital's there is sort of the headline here. And, you need to have all these things ironed out, because I've been in this position where, you get to closing date and things get a little bit more expensive than you thought, and things are a little tight. And I've had many sleepless nights a few days prior to closing. So if you make sure all of this is settled during the research phase, you are going to be miles ahead. So please consider your financial requirements.
I did not bring a so I guess I did kind of have a financial partner. I have 5 rentals myself, and I have 5 with my partner, Nick. So during the time when I was house hacking and I just quit my job, I actually didn't have the self-employed income history to buy more rental properties. And the way we got around that was my friend Nick, he had a great W-2 job. So we owned the next, 4 or 5 that we bought, jointly, but he put the mortgage in his name on those because I couldn't. And then since then we've bought some more, and I've put it in my name to kind of balance things out. But that was my capital partner. It was a friend with a good W-2.
Yeah, no, that's great. And it's the same thing here in Canada. If you have self-employed income, it's much harder to get properties in your name unless you hold them in a corporation, and then that gets a little complicated.
Yeah, luckily it's easy now that I've had 2 years of history, but during that 2-year time, it was not possible.
Yeah. All right. I think, yeah, there we go. Next slide. And taxes, every investor's favorite topic. But actually, to be honest, for me, taxes, I love talking about taxes because I work with a great accountant, and I'm able to maximize all my deductions. And it's actually a lot of fun when you're, legally putting money back into your pocket. So I'll go quickly on this, but during the research phase, there are deductions that you can claim, but please work with an accountant. Ideally, you work with an accountant who specializes in real estate investors and works with real estate investors. I can't stress this enough. Okay, so deductions during the research phase, anything from travel to and from the properties you're looking at, mileage, any groups or memberships that you're involved in, professional fees, education, conferences, building that network to build up your lead flow. And we're going to get into the acquisition phase after this. Your home office, where you analyze and research your deals. So all of these things are critical during the research phase to know that you can claim them as business expenses. And we'll get into this, but Stessa has some pretty cool tax features and can automate a lot of this of tax reporting. But we'll get into that later.
I'll tell you, from me not being very sophisticated with taxes, my accountant will ask, "Hey, can you send me the report on your rental properties?" And I used to have this pit in my stomach. I was like, "Oh, I know I'm going to have to catch up on 12 months of bookkeeping." And, that was never fun. But now with Stessa, I just export it and send it to him. And it kind of auto syncs all the mortgage and expenses and classifies what property they were for. So that's one of my favorite parts. Just did that because we just hit tax season. Hey, before
a much better working relationship with my accountant now that I started to automate some of these things rather than handing them a box of,
Yeah. All right, let's take a moment here before we go into phase 2. And let's recap what we learned in phase 1, doing due diligence. So what was your favorite part that you guys learned in phase 1 during the due diligence part? Go ahead and let us know in the chat. What was the number one takeaway that you guys had?
The threats.
All right, Brandon's saying the main threats, which I believe he means vacancy and interest rates. And let's see, Dalton, I like the stress test idea. Should start doing that. Make sure your net operating income is not negative. That's right. And make sure you include all your expenses except your Capex. The key metrics, rule of thumb, 1% rule. and doing the research ahead of time. That's great. So I also want to let you guys know, if you guys have any questions throughout, you can put those in the chat. We're going to have some parts where we pick the best questions and bring you guys on to chat with us about it too. So type in that question at any time. We're going to keep rolling into phase 2. Oh, Jacob says, what is CapEx? So capital expenditure is what it stands for. And what I consider CapEx, I'll make sure Brad keeps me in line here, but basically I bought a new rental. I put it in my system as a rental, and then I like replaced the whole kitchen, so that's not regular maintenance, but that was a capital investment that I decided to make. Is that pretty accurate, Brad?
Yeah, absolutely. Or, your furnace goes and you got to replace it, or your roof goes and you got to replace it. It's just the major expenses that aren't necessarily recurring.
Okay, got it. Okay, Brandon, we got a few questions here. This is good stuff. Let's see. Brandon, Austin, keep those questions. I want to bring you guys on and let's talk about it. Let's get through phase 2 real quick first, and then we'll get back to those. So, okay, phase 2, how to land great real estate investment deals with less work. And I was thinking about when I was playing that cash flow game. So if you guys haven't played it, it's actually a free game still on the Rich Dad website. Used to be this $300 board game, but now they made it free, which is great. It's an educational tool. It's not a game. But you basically try to get out of the rat race. And one of the things I noticed when I was playing with my roommate was we had like a different way of analyzing the properties. What he would do is he would buy a property that cash flowed negative $100. That would be the net operating income that Brad was talking about, I believe. That would be equivalent. Yes. Yeah. Okay. But he would buy that. He would buy a bunch of properties that had negative cash flow. He had a lot of hard time getting out of that rat race. I did not buy those. I only bought the properties that had positive cash flow. And so I think that was a eye opener for me, that I just needed to analyze it right and make sure it cash flowed. So how do you find deals that cash flow? So the first thing that you can do is you can look at the MLS. So that's where all of the retail deals are available that you're familiar with. They are typically listed. They're always listed by agents. And there's some pros and cons to that. My first actual rental, so after the house hack, I did buy a proper rental that was only a rental. And I actually found that on the MLS, it was like 120 days old listing. It had been on and off and on and off. His buyers, he had 2 buyers, they were under contract, and both of them ended up falling through. Their financing fell through. So this guy was like, dude, I want to sell this house. I'm trying to start a bar. He's like, I'm selling all my rental properties. My dream is to go start this bar. And so I came there, and so I offered him, I was like, hey, I'll offer you, 15,000 less than your listing, but I promise you I can close, and here's how, here's my proof. Here's my proof of funds, XYZ. And so I ended up getting a great deal off of an MLS listing that was old. And so the pro is you can see everything. You can just lay in your bed and browse, right? That's what I was doing. The con is a lot of the MLS deals probably won't be great deals because they're listed at the retail market, and they're not really, in my experience, a lot of them didn't cash flow. That's the con. So your other option is off market. So some traditional ways to find off market deals is word of mouth. There is a very big time builder up in Carmel, Indiana. His name is Justin, but he got his start buying rentals from people at his church. So he was very active with his church. And he was just spreading the word that, he was looking for houses to buy. So when somebody needed to sell their house in Carmel, and they would tell Justin. And so Justin bought it, and sure enough, he just kind of accumulated a bunch. And that's kind of how he started. Now he bulldozed all of them and built, new subdivisions. So, okay, the next one is your neighbor's moving. So this guy worked for Josh. He actually heard that his neighbor was moving. And so he approached them before they listed it with an agent. He said, hey, an agent, may take a fee. And if you're okay with it, I'll just pay you what the market rate is. If we agree on that, just minus the agent fees. So that's how he got his first rental, is he noticed his neighbor was moving. There's a lot of bandit signs around town. And from what I hear, they work. I've never personally done it. And I know in a lot of places it's illegal, but I'm sure you're familiar with that as well. And then door knocking. Is there anyone here who sold Cutco knives? That's like the go-to door knocking experience that I hear people have. And that applies really well if you're looking for a great rental property deal as well, if you have those skills. I did not sell Cutco knives. Did not have that experience. It's a grind, but it pays off. Okay, let's go into the modern way to find off-market deals. So I used to be able to buy from wholesalers. This is something I've noticed over the last 5 years. I used to be able to buy deals from wholesalers and feel like they were a good deal. Now, these Wall Street hedge funds are trying to buy hundreds of deals per month in my own city. So just imagine what they're doing across the country. They're actually willing to pay like 96%. They're paying like 100% of what the retail value is. And for me, as like a little guy, 10 rental properties, I can't do that. It doesn't meet the 1% rule. But the Wall Street guys, they got the economies of scale. They've got their own numbers that I don't understand, and they can make it work paying that much. So that's why I can't buy from wholesalers anymore. What I do instead is I find my own deals. And I started driving for dollars. It's where you guys look for a rundown house. That's originally what I built DealMachine to help me do better, easier, was driving for dollars. That's evolved. That, the advantage of driving for dollars is it's the best return on investment. You can't buy that list of rundown houses. You've got to put in the work to find it. But because of that, you don't have to spend as much marketing to find a great deal. We have a list builder. Some people prefer to get leads faster. You'll have to spend more on marketing because it's easy to buy those leads, but it still works. So you've got the list builder, and then you can reach out through SMS, you can reach out through direct mail, and you can reach out through skip tracing. And skip tracing is when you get the owner's phone number and you give them a call. And so those are the main ways that I would classify as the modern way to find off-market deals. Okay, so before we go into optimization, which Brad is going to lead us through, this is the final phase. So we're going to get back to your questions, guys, and bring you on after phase 3. What was the number one takeaway from phase 2, in terms of acquisitions? Okay, and Alexander says, what about buying leads from websites? I'm pretty sure that's the same thing that I was mentioning with the list builder and DealMachine is you can actually filter the leads that you want and then like download those into your app and then market to them from that way. All right, so Paul's saying you need to have money to find those deals. That's right, Paul. The lowest cost way to find those deals yourself, though, is driving for dollars. Lamar, off-market deals. Elise says MLS and traditional off-market does not work in today's market. I wouldn't say it doesn't work. I only just mentioned it's the pro is you can see it. It's all there. The con is you have to search for that special deal because not all of them will be cash flowing. Let's see. What does one do when they are, oh, glad I didn't read that out loud. I'm not sure I understand the question, Austin. Let's go on to good transition for Brad to talk about some optimization.
Yeah, thanks. Thanks, David. And I'll just mention too, like if I take a look at my current real estate portfolio, the top 5 performing assets in there were all off-market deals. They weren't MLS, they weren't traditional sales. So if you can master that off-market, like you mentioned, the modern way, then it puts your portfolio on rocket fuel. All right, Matt, are we good? We're good for For questions, you wanted to mention something? We're good? Okay.
Yeah, I was just going to say, as David had been asking, keep throwing your questions in the chat here. And after phase 3, we'll start to bring you up and actually, I'll promote you as a panelist. And that way you can ask your question and have a little bit of a conversation here and keep it interactive. So feel free to throw your questions in the chat and, I'll pick out a handful of the best ones.
Perfect. All right, so phase 3, final phase. So we've, the hard part's over. You've done all your initial due diligence correctly because you've listened to us and you've attended this webinar. You've acquired an income producing asset. Now you can sit back and go open a bar like the dude in David's story, right? No, we want to optimize. The optimization phase of real estate investing is probably the most overlooked. A lot of investors have this sort of set it and forget it mentality. Some are fatigued by the first 2 phases that's what I've experienced, but it's really critical as an investor to know the right strings to pull in your portfolio to optimize for revenue. So the biggest mistake I see in this phase is the pricing of your rental unit. You price it too high and you risk vacancy and turnover, which we know is a cash flow killer, and you all know what cash flow is now. And too low, and you're putting downward pressure on your bottom line, and you risk locking in a low-paying tenant who will never leave. The first rental I bought, I completely missed the boat on pricing it. We were just excited, right? Like you get your first rental property and it's like, okay, whatever, we just want to get someone in there. We got a tenant in there for well below market rents, and big surprise, she's stayed there for 12 years and hasn't left, and we can't raise rents. So now we're cash flowing about negative $112 a month on that. So don't make the same mistake I did. So how do you price it right? So you can work with professionals like brokers and realtors who know the market. You can browse Craigslist or any Canadians up here. We've got Kijiji, Zillow, other listing sites to get a feel for market rents. There's tons of calculators out there. Stessa has a rent estimate feature, and I'll give a shout out to David and DealMachine. They have a comps tool that's really good, I hear. So I'm right in saying that, right, David?
Yep.
Yeah. So I mean, the headline here is that there's so many resources out there and tools that you can use. There's absolutely no excuses for mispricing your asset. Don't try and sit there and beautiful mind rents by yourself. Use all the tools available for you. Don't take it alone. It's a recipe for disaster. Quickly, taxes. So we talked about tax strategies a little bit, but this is where most investors leave money on the table. So 2 things with taxes is education and professionals. So educate yourself on all the deductions and depreciation you can claim. If you haven't heard of depreciation, write it down on your notepad. Keep watching the webinar, don't turn it off. But as soon as the webinar is turned off, go look up depreciation. It is a wonderful thing. And if you have an accountant, tell your accountant to educate you on it. If you don't have an accountant, write it down on your notepad. Don't turn off this webinar. After the webinar, go find an accountant. And the other big things, like I said, is education. There's tons of guides out there. Stessa has one, and we'll put the link in the chat after this. So there's really no excuse these days with all the education out there to not be familiar with how you can optimize for your taxes. And you don't just need to rely on, like I said, your shoebox full of receipts and doing it all yourself at the end of the year at midnight before the tax deadline. All right, we can move on to the next slide. Anything else on that, David?
No, I think we're good.
Okay. All right, so I'm going to talk, like I said, I love metrics. You're going to be tired of hearing me say that. So I'm going to talk about a few more metrics that are really critical during this optimization period. It's not just cash flow. You need to know a few others. One of the big ones is cash on cash return. Cash on cash return will tell you based on your invested capital what your returns are going to look like. So your cash on cash return will matter to you, especially as you're looking at multiple assets in your portfolio. And it's especially going to matter if you have other investors involved who have put in money. They're going to want to know what their cash on cash return is. I mentioned before that cash flow doesn't really tell a story. Cash on cash return does tell a story. It tells you based on your input, what return are you getting? So cash flow, again, just tells you a number. So consider someone getting $100 a month in cash flow versus $500 a month in cash flow. Which is better? Most people want to say the $500.
$500. Yeah.
Yeah. But if the $500 cash flow is coming from a property that you bought for $1 million and put 300,000 down on it, is that really that much better? It doesn't really tell you the story. Whereas the $100 cash flow on an asset you bought for $80,000 with $10,000 down, it's a bit of a different story. So cash on cash return really tells that story versus cash flow really doesn't. But cash flow is a good tool right up front to do your research to make sure at the end of the day, is there going to be money left in my bank account? Happy to talk more about this in question and answer. The second one I'll mention is the operating expense ratio. I should mention, sorry. Yeah, no, I mentioned how to calculate cash on cash return. It's your net cash flow divided by the capital you put in. So you need to know your cash flow and then the money you invested in the deal, and you divide those two, and that'll give you a cash on cash return. Usually, I mean, cash on cash return can vary, but 8 to 12% is typically a standard good cash on cash return that folks will look for. And I'm happy to answer more questions about this. Shoot them in the chat. Operating expense ratio. I really love this one because, again, when you're looking at different assets, you can alert you to one that you're overpaying on utility bills or maintenance. It's a great way to compare different properties at an expense level, which has an impact on your bottom line. The operating expenses for this calculation. So you take your operating expenses, which we used in our net operating income calculation, and you divide it by your gross rent or income, and not necessarily rent, all the income you get from the property. If you have parking or laundry, all that stuff, you divide that by your operating expense ratio. So obviously the lower the number, the better, but typically you'll see an operational expense ratio of 60 to 80%. But that should, you should be optimizing all your assets to have a lower OER. Accounting. So part of the optimizing phase is for revenue is accounting. You need to track your financial ins and outs of your business at all levels. And like I've said a couple times, we can toss out the shoebox full of receipts. There's so many better ways to do this now in a digital age. Platforms like Stessa automate the various financial reporting tasks. So you don't have to do it manually. Don't do it manually. That's why you have these tools to help you out. I love this. When I pull up my Stessa dashboard, all of my accounting numbers are there. Everything's optimized. It's plugged into my bank accounts. It's easy.
Mm-hmm.
And we'll get into that. We'll show you in the demo as well. And property management software, I'll just be quick on this. In my opinion, everyone should use some sort of property management software. It's sort of like the technological engine for your investing business. You can manage tenants, work orders, payments, documents, all that kind of stuff. And property management software comes in all shapes and sizes for someone who has just a couple of properties to someone who has hundreds. We've all heard of the Buildiums, Appfolios. There's literally dozens and dozens out there. I think everyone should at least take a look at them to see if it fits their particular needs. I'm not going to endorse any specific software, but it's important that that they're out there and that you should use them because they will help with that optimization process, because you're doing less things manually, and that's when mistakes happen.
Awesome. So now we're going to move into the Q&A section. I'm seeing a lot of good questions here. Matt is going to be looking through those and bringing you guys on. And so when you guys come on, make sure to turn on your mic and your video so we can see you.
All right. Should be able to bring on Austin here. Austin, you had a handful of good questions. So I knew you were asking about a property management company, how to handle, rowdy phone calls, a few different things. So do you want to fire away a little bit?
I was kind of relying on the chat to remember what exactly I said. Well, the first thing was, sure, first couple properties, it's really not worth the expense to hire a property management company. But after a certain point, it, at least to me, feels like that's just for the sake of for the sake of brevity, for the sake of just
You're-
keeping everything running smoothly, the way to go, unless I'm wrong.
Yeah, but I'll speak to my experience. So I don't have a property management company yet. I have 10 properties, but if you look, I mean, I think the properties are bringing in $60,000, $70,000 a year passively, and that's not money that I'm like using in my bank account. That's just like what they're driving. So like my time is you could probably get, your time is worth a certain dollar amount. So you have to decide how much is your time worth, and when is it worth just paying the $200 a month or the $100 a month to have somebody manage that for you. Brad, I'm curious at what point you guys decided that.
Yeah, we still self-manage, and I obviously have partners that I work with, so I'm not necessarily the one knocking on doors as much anymore. But it really depends, Austin, on your goals. Like, are you into real estate investing to replace your W-2 income? In that
Absolutely.
case, yeah. So in that case, you may want to hold off as much on that. And I always suggest to investors, manage the first couple yourself, just so you can walk the talk. When you do eventually hire a property management firm, they can't fleece you. You got to be very careful, get references, all that kind of stuff. But if your goal is to just have, a couple properties, and in 20 years you'll have a nice retirement income, then maybe property management is right for you. It just depends on how active versus passive you want to be.
Trying to think.
Yeah. Hey, David, can I jump in and strongly endorse Brad's last comment about doing the first couple on your own?
Of course.
From my perspective, I own a couple properties out of state and I self-manage them. And that's very deliberate. One, because I love learning new things, and you learn a lot more when you've got your hands in there directly. And two, all property managers are not created equal. So while a really good one can make your life, wonderful and, help you achieve goals very quickly and grow your portfolio, a bad one can make your life really painful. And it becomes negative leverage at that point. And the frustration I've had paying someone to do not an awesome job, to lose my tenants, to forget to raise the rent when they should, to screw up a maintenance request, can be really frustrating. So until you're in a good position to evaluate people, based on their experience, get references, find the right property manager, I would recommend managing yourself and then getting yourself in a position to pick the right person to help you grow.
Devin,
That's kind of how I think about it.
Really glad that you spoke up, especially because you manage them yourself from a distance. Could you speak to how do you manage it yourself from a distance?
Yeah, well, two things. So I'm in California, and the two properties are in Hawaii. So number one, it's a place I actually want to go and spend time. And so I have other reasons to go there, which is great. So that makes it more convenient. And then at the same time, when I first bought the first property, I spent a month there, and I had two plumbers come, I had two electricians come, I had 3 different yard guys come. And so I sort of evaluated people and, have a go-to person for each possible problem that comes up that I can call directly myself. And so, I also text directly with my tenants. They know they can check in with me directly anytime. And so we close the loop on open items really quickly, which makes everyone happy. And I think in the end saves me money too. It's more time, I have to have the time to do it myself. But I've set up my life so that I can do it that way for now, at least.
I'm getting my next rental in Hawaii too.
There's definitely no 1% rule. It's kind of the like maybe 50 basis points rule at best. But I think about it a little differently. I project appreciation. I look at the appreciation that's happening year over year to make sure that I'm getting the expected return out of appreciation and the value, not just the monthly cash flow. And so some months I have no cash flow because I'm investing back in the property. doing CapEx, whatever it is. And even in the best months, it's nowhere near 1%. But, hopefully over time, 5 or 10 years, you get there.
Yep.
And you've got the appreciation on top of that.
Mm-hmm.
But, different markets behave very differently.
Thank you so much for sharing that perspective, Devin.
Yep.
And thanks, Austin, for your question. Matt, do you have anyone else lined up for us?
Yeah, Paul had asked a couple of really good questions here, so I'll bring him up. Let's see. Paul, hopefully here. There we go. Paul, can you hear us? Maybe.
Do you remember his question?
He had a lot of questions.
Yeah, he had a handful of pretty good ones. Everything from how do you integrate property management software with full service property management for long distance landlords. Asked about maintenance and vendor coordination. Tips on that.
Oh, I have a tip. Okay, yeah. So I don't have a property manager, but I have this handyman that I keep on like a retainer. So I have 10 properties and I guarantee him $200 a month as long as he responds to any tenant complaints or requests and solves it within 24 hours or like tells me there needs to be an exception made. So that's actually worked out really well because a lot of my management activities were really just like coordinating stuff on the phone or text with like my plumber or my electrician or whatever the problem was. Glenn, he can handle like 90% of the stuff himself. So he gets 55 an hour, but my $200 a month covers the first 4 hours. Okay. So if he doesn't get called at all, he gets $200. If he gets called total of 4 hours, he gets paid $200. And if it goes to a 5th hour, he gets 55 extra dollars. So that's like one tip that I recently did last year that saved me a lot of time. I don't have to coordinate with my tenants and my repair guys because Glenn does that. And he can just handle some stuff as well. Do you have any other tips on that, Brad?
Well, just to reiterate, we have a handy person we work with, and we do the exact same thing. We pay him a retainer, and any issues that come up, he'll try and handle himself. And if he can't handle it, then he has his network of contractors that he reaches out to. So he's sort of like property management light, that anytime there's an issue, we call him and we pay him for that. If he doesn't get a call at all in 1 month, he still gets his retainer amount. But if he does get a call, and we pay him for his time if he goes to the property, but just to know that you have someone on call 24/7 that was the best advice that I ever got.
The retainer was like a life changer because they're incentivized to prioritize you. Before I did that, I was struggling to find a handyman that was like consistent. So it's awesome to hear you guys do that too. John Thompson, how you doing, sir? You hear us?
Man, having bad luck with connections here. He asked a question around how do you decide when it's a good time to switch away from flipping to buying rentals and keeping over flipping. He can hear us at least.
That sounds like a personal decision. I've never been into flipping just because I'm not handy myself. I've always been a buy and hold investor. And flipping, I find very resource intensive. It's great for getting started, especially if you're handy, because you can create your own value very quickly. Versus buy and hold, typically you need a chunk of money. Versus flipping, you could get away with a very little amount of input and some cash out relatively quickly if you do it properly and get the cash out refinance. So there definitely is a value to flipping, but I mean, if you're doing flipping over an extended period of time, it sounds like that's your job. And maybe you like that, but if you want to get out of flipping, maybe consider keeping some of those properties in your portfolio, but that's just my opinion.
Yeah. I actually was thinking about that myself because we've had so much appreciation. My portfolio is appreciated over $200,000 in the last year. And I was like, man, I mean, that cash is like important. That would be amazing to have that. But what am I going to have to do when I find the cash? I'm going to have to find another investment, which takes time. And it took me time to get these deals in the first place. So I decided just to keep them because there's a transactional cost with these properties, right? There's time and money that you pay to do a transaction every time. And so personally, that's why I didn't choose to sell anything, was because my goal is long-term. If I just had the cash, I'd have to spend more time and figure out what to invest it in next.
And remember too, with flipping, I don't know how it's taxed in the US, but in Canada, it's considered more active income. So it's not taxed very favorably as well, versus buy and hold. It's a lot more favorable in the tax man's eyes.
Yep.
Until they raise capital gains tax, which we'll see what happens.
We'll see. That's right.
Austin, we lost you earlier, but you had you've been continuing to fire away with good questions. So I wanted to bring you back up to give a second chance there.
I don't know what happened. Something I thought of just a second ago. What exactly would we be responsible for in the event of the building needing repairs? I understand, obviously, basic maintenance, making sure the building is up to snuff when the tenant moves in. But, what if they overload the dishwasher and cause water damage, something like that? Would we still be responsible, or would that be on them?
How do you handle that, Brad?
It really depends. I mean, the general rule of thumb is that anything that is tenant has caused something, or was just general wear and tear based on them being there, we make them do the repair. But if the appliance goes on the fritz, or something is broken, on the outside from no fault of their own, like we will fix it. I think there's different rules depending on what jurisdiction you're in. So it'd be really important to be aware of those and talk to investors who have been there, done that kind of thing. But at least here in my jurisdiction, anything that's wear and tear that is just sort of lifespan, the landlord will have to cover if it's caused by a tenant. Like they put a hole in the wall, that's not really on you to go and fix.
Good question, Austin. Hey, we've got 5 more minutes for questions. So Matt, bring on a couple at a time maybe, and we'll do like a lightning round of questions. And then what we're going to do is transition into, we're actually going to look at my actual Stessa account. So you see all my properties and portfolios, and we'll kind of show off what Stessa does for me live with you guys. So stick around for that.
All right, Brandon, do you want to jump in with your question first? You had a couple of good ones here that I wanted to draw attention to.
Oh yeah, sure.
Hey, Brandon.
Hey, how you doing, David?
Awesome. Good to see you again.
Good seeing you. You guys are doing some real good stuff. Really appreciate it. The one question that came to mind: do you guys use month-to-month leases or yearly leases? What's the best one to go, and the pros and cons of both?
What do you guys do, Brad?
Yeah, we try to go yearly. We're not afraid of month to month, but I don't like going anything above a year, just because that locks you into a specific rental amount. I don't like month to month either, even just starting. It doesn't really give you that certainty that you want as a real estate investor. I like to lock tenants in for the year. And I mean, it depends on the jurisdiction. They can get out of a 1-year lease, at least here in Canada, if they give you a certain amount of notice and all that kind of stuff, but it's a bit more certainty if you do the year lease. What do you guys do, David?
Yeah, I only do year leases. I will only do a month to month if somebody is completed their year's lease and they are telling me in advance that, they need to stay an extra couple of months before they're, taking a new job or whatever. That's the only time I'll do month to month. What's funny is when I first started my very first rental property, I thought that it would be advantageous to lock them into like a 3-year lease. And that's actually what I did. They were like, hey, will you take $200 off a month if we commit to 3 years? And I was like, yeah, that's amazing. You're like, I don't want to re-rent this thing in 3 years. But what happened was, it was her and her boyfriend that qualified for the house together. They broke up. She couldn't pay for the payments herself. And so I didn't want to evict her, but she was like, no, I'll solve it. I'll solve it. What she did was she got another boyfriend to fill the spot. So he moved in, and then that didn't work out after about 2 months. And then I was like, hey, I don't want to not foreclose. I want to evict you. And I understand you're in a tough spot. I was like, you need to probably find a friend, like move into their basement for a few months, get back on your feet. I'll let you out of the lease as long as you decide to do that, like in the next week. And then she did that. So let her out. And I was like, yeah, I probably don't need to do a 3-year lease again, because as I kind of saw there's no guarantee that they'll actually be able to hold up their whole end of the deal. And if they were like a pain in the butt tenant, I'd prefer to have the ability to raise the rent after a year rather than have like a pain in the butt tenant like locked in for 3 years too. So I don't do long leases anymore for that reason.
I guess, and one more question. So when a tenant misses like a rent payment, what's the proactive thing to do? So like when they miss that first, like their first rent, I guess what's the proactive thing you guys do before that tenant become classified as a bad tenant? Like what do you guys kind of do before it gets to that level?
Yeah, go ahead, Brad. What do you think?
Yeah, so we have a whole standard operating procedure for all that kind of thing. So if, one day after rent is due, if rent's not there, then we'll send out an email with, it's a bit more cordial email, like we're here to help, like let us know your situation. We want to work with you, because at the end of the day, everyone has issues. Like we're all here, we're all in this together. We're all here to help, especially given what's happened over the last 12 months. And then certain things will happen after if they don't respond, or if they just say, I'm not paying you, then there's certain forms we have to initiate to at least cover our bases. Like just because someone doesn't pay rent doesn't mean I'm going to evict them the next day. It's just, you have to cover your butt as a landlord, because if it does become bad and, legally they go back and look at what you did in those days following non-payment, and you didn't do anything that was proper, then you're going to get in trouble. So I would suggest being firm, but be understanding as well, and go through the regular legal process that you need to go through. But it's not to say that you need to do something dramatic the first time rent is missed.
Thank you.
That's
Great.
more systematic than I have in place, but what I default to is if they're late once, like I want to know why, and I want to know, are they communicating to me, or did I have to like discover it, 15 days later and they like didn't even say anything. So I want to figure out why first. And if it happens like once, twice, they may never ever catch up again. I've never evicted somebody. I don't want to go through that process. So what I typically do in that case, when a situation comes up that's tough for them, is I give them that offer that I said before was like, I don't want to go down the eviction process. I get you're in a tough spot. Here's my offer. Like, if you can't make the payment, like, please, like, just like, go get back on your feet with a family member or friend, but make the decision quickly so that I don't have a big battle or like a big vacancy. And that way you don't have it on your record either. And that's worked for me every time so far.
Okay, cool. Thanks, you guys. Thanks again, David.
Thanks, Brandon.
Yeah, Brandon. Hey, did we have somebody else?
I did have one. Yeah. And Devin, thanks for answering the quick fire Stessa questions in the chat there too. But
no worries. I'm trying to keep up here.
Yeah, that is great. Yves, if you can hear, it come with a question. I'm new to real estate investing. Do you recommend an LLC or umbrella coverage for a portfolio of 2 properties? And then after this, we can jump into the demo.
I don't know how. If you were in Canada, I would say probably not, and that may be the answer for the US as well. I mean, with 2 properties, I don't necessarily think it's worthwhile, but I don't know, David, you'd probably know a bit more about the litigious nature of the US.
Yeah. Well, when it comes to protecting yourself, if you ask an insurance salesman, they're going to say do it with insurance. And if you ask a lawyer, they're going to say do it with an LLC. To me, the LLC was like a pain in the butt. I was like, oh, I'm gonna have to file these taxes for each one. And I did the insurance route. I just got an umbrella policy, and they're all in my personal name right now. Now, as the portfolio grows, I'll probably change that, but that's how I approached my first few, is just keep it simple, keep it in my own name, just snag the umbrella policy for like, it was like $100 a year or something for like $1 million of coverage.
Yeah, that's the same for me. I found that the more I looked into LLCs, the more the promised benefits don't really materialize, especially being a California resident. There's $800 per year
Yeah.
extra fee on top. And then, it's depending on whether, if you're actively managing yourself, it's really hard to actually have this legal entity protect you if you're making decisions, if you're picking up a hammer sometimes. It's not always clear that you actually get the protection you think you're paying for. So for me as well, the insurance route seemed to be the way to go.
I'm with you there, Devin. Same thing. Thank you guys so much for bringing your questions. We're still going to have time for questions throughout this demo, so keep firing them in the chat. We've got people to answer them, but I'm going to go ahead and share my screen. And we're going to do a quick walkthrough of Stessa. So this is my actual portfolio, and I'm very excited to have the Stessa team giving me advice. But first, we're going to go ahead and let Victor walk us through. Victor, are you there?
Yeah, I'm here. Thanks, David.
Awesome.
As David mentioned, I'm Victor. I'm a customer success manager here at Stessa, and I just want to give a quick walkthrough through David's account here. So the first thing we see at the very top is just a couple squares. This is our dashboard view. Those 8 squares, we have portfolio value, asset return, occupancy, income, debt, properties, unit, cash flow. I know this webinar talked a lot about cash flow. The one on the bottom right there, it's listed nice and clean. I do want to give you a heads up. That cash flow is calculated by pro forma figures. So pro forma is all the estimates you expect for that property. So this is kind of what you're expecting from all your properties, the cash flow to be. Right below the 8 squares there, we have our net cash flow by a month graph. These are actual figures. All this data is being populated from the transactions. If you have your bank account linked, the transactions are being fed, or if you manually enter a transaction, it's all here. David mentioned that he had a pretty big capital expense, and we can see very clearly here in November, it's pretty big. But if you don't want to look at it, on the right-hand legend there, do you see capital expense at the bottom, David, in brown?
Yeah, this?
Yeah, go ahead and click on it.
Oh, cool.
And then we could take it off, and then you actually see what things look like without that expense. So that's a nice little feature. Also, if you hover over one of the months columns there, one of the month rows, it splits it up for you. So what you can see there is the total amount for each type of transaction. And if you go ahead and hover over, let's say the income, if you can, in that April 2021 pop-up square.
Sorry, I lost you. Where's the April?
Oh, no worries. Yeah, so the little pop-up, do we see income?
The green?
Yeah, but on the gray square, that little popped up right there. Yeah, try to get into the pop-up.
When I move my
Yeah, with a mouse. Sorry about that.
I don't think I can click it.
Oh, well, what it does, it takes you to the transactions page for that month.
Oh, okay.
Yeah, so it's still a nice view. So looking at that month, if you click on the month, it'll take you to the transaction, so you can see exactly where everything's coming from.
There we go. Yep.
Perfect.
So then I could categorize income right here.
Yep, perfect. So you can see
Beautiful.
everything that came in for that month listed as income.
Beautiful.
Great. Can we go back to dashboard? So we scroll down a little bit more. We have a nice little map view. It pinpoints all the properties you have. On the left there, we have cash on cash. I know Brad mentioned it. David's cash on cash is negative right now, but if you want to go ahead and click on view monthly cash on cash, it breaks it down and you can see that there's a huge dip in November, which takes into account the capital expenses, and that correlates with the map above.
Got it. So I'm curious, is there a way that I could hide the capital expenditure in the cash on cash return?
Not on this card, but
Okay.
yeah, because it is calculated in the cash on cash.
So
Yeah,
I think what I
you're-
should
I mean,
have
in some
done-
ways, you're a victim of your success here, right? You've got very little cash in, which is
Mhm.
why the percentage is flipped so negative when you do have a considerable expense,
Got it.
right? So you've done a good job either pulling cash out, refinancing, or not putting much in to begin with, which is great. But then and that's why I think over time we try to get people to move away from focusing too much on cash, because it becomes less relevant the further you are from your acquisition date,
Yeah.
just because so many things have happened, other big ticket items.
So I bought the house and then I put it in Stessa and then I renovated it and then I just refinanced it last week. So if I probably should have maybe not put it in Stessa until it was until it was like a financed rental property. Would that be a good strategy going forward for me?
Yeah, I feel like that's one way to do it. Stessa's optimized for more stable, long-term buy and hold situations. We have not built features specifically for fix and flips. So, there may be some wonkiness in how we're running the math in that time period before you get it fixed and stabilized.
I was just
Absolutely.
pumped because I got a new property. And I was like, I'm going to put it in Stessa right away, day one.
Yeah. Well, I mean, you can absolutely can do that. Like, you want to track it, right? You want to see what's going on. You just have to keep that in mind when you look at the numbers.
Yeah. I like this too. I like seeing the pie chart of all my rental prices.
Yeah, just more data, gives you all the properties at the bottom there, color coordinated. You can see square footage, market value. It's a great overview of your whole portfolio.
That's awesome.
Yeah. And actually at the top, do you see dashboard for all properties at the very top?
Yeah.
Almost right
So
there. Yeah.
this is so cool. I couldn't believe you guys had this feature because like I said before, I own half of my portfolio with my partner, Nick. You remember we bought the properties together when I didn't have the W-2 income. And so I thought for sure we were going to have two Stessa accounts, but you guys have the ability to like section off who owns what portfolio, which is amazing.
Yeah, so that's our collaborator feature. You can set up specific portfolios, send invites to other people. Those people will be able to see any property within that specific portfolio.
And I, just to pipe in, like I use a lot of JVs for joint venture partners for my properties. So this kind of feature is amazing because you can see it right all in front of you, even though there's multiple people involved in multiple different properties.
Really awesome job with this feature.
Thanks. And actually, David, can you do me a favor? Can you click on one of the properties there? Let's see. Yeah, there we go. And actually, so the view on the dashboard for this specific property will change a little bit once you go down into property value, different little layout. And at the very top, again, there was one key metric that we mentioned back at the top of the 8 squares.
I don't like this property. It doesn't look very good. Let's go look at a different one.
Yeah.
There we go.
Cool. Yeah, looks great. All the transactions are in there, amazing. But at the top, we have listed income, net operating income, cash flow, and occupancy specific to this property.
Yeah.
Okay. And again, just a quick reminder, those are pro forma numbers. Those are what you expect. And then you could break it down more in the net cash flow by month graph. And your cash on cash on that one's 113%. So that's pretty awesome.
Yeah, I want to do more of these deals.
Yeah.
Found it with DealMachine, everyone. All right, where should we head next, Victor? Should we look at anything else on the left-hand side?
Yeah, actually, let's go ahead and go to leases and tenants, if you don't mind. So this is going to be our complete leases and tenants page. It's going to tell you everything about the tenants for each property. If you don't mind, David, you want to choose one of the units, I would just love to show the breakdown of the tenancy and the tenant ledger that we have available. So this is where you enter the details, the move-in date, the rent history, and at the bottom there is our newest feature, which is the tenant ledger. So this is a quick view to see the charges, the monthly rent, and then the payments. Once those transactions are assigned to the correct property and unit, they will populate here and you can see what the balance would be for each specific tenant.
This is great.
Yeah.
You guys have added a lot since I've been on this specific page. And then future tenancy, is that if I have somebody lined up to fill the house when it renews?
Yeah, if you have somebody else, you could go ahead and do that. So let's say this current tenant, the lease expires and they don't want to continue, they don't want to renew, you go ahead and add future tenancy and create a new tenant. All the data will be saved, all the transactions will be saved for this specific tenant. If we go to the transactions page, you'll be able to select per tenant what the income gets assigned to. Cool. And then, yeah, that was actually my next step, was the transactions page. This is where I recommend people to spend, majority of their time. This is the source of truth for your account. You just want to make sure all the amounts are in, double check dates. Sometimes banks, they receive it, but it takes a couple of days to post, and then it'll take a day to get to Stessa. So everything's there. The properties are assigned correctly. This is where all the reports are being fed from.
I like this page a lot. I come here to make sure that you have automation that already tags, like this Venmo cash out for this amount is Grandview. Like, you guys know that 7132 is $1,500 a month. So even though a bunch of these are coming from Venmo, it's awesome. You guys already know what to classify it as.
Yeah, we use machine learning. So after, I want to say, maybe 3 transactions, if they're not categorized automatically, and you do it manually, the system should recognize it and do it on the next one. We also try to read some of the descriptions, like for example, Home Depot. If a Home Depot transaction comes in, we'll probably put it in repairs and maintenance.
Got it. Yeah, it's awesome.
The next step, let's go ahead and go documents. It's a nice storage area.
Victor, can I mention one more key thing on transactions specifically? So the best way, the easiest way, the smoothest way to get all your data in there is to hook up your bank accounts. So we go through Yodlee InvestNet, who's a secure banking provider. You can, just like Mint or Personal Capital, you can connect to thousands of US-based bank and mortgage companies. So typically we can pick up your loan information, and then whatever checking, credit card accounts you use for your properties, we can tap into that data directly, and it refreshes automatically nightly or whenever you log in. And it makes it really easy to keep track of things, especially if you're organized on your end with either separate accounts for each property or a dedicated credit card for all your properties. The more organized you are, then the easier it is in Stessa to tag things quickly.
And to piggyback on that, we're actually also integrated with AppFolio and Propertyware. So if you do use a property manager, that could also sync up, and it just smooth automatically pulls transactions from those property managers into your Stessa account.
Yeah, that's one of the things we found talking to people 2-3 years ago that they spent the most time on and was the most frustrating for them. They had Google Sheets, they had shared Google Sheets with partners, things would get missed. Somebody would have a charge on their credit card and they forget to put it in there. And so this is one way to, see everything in one place. And that's really what we're going for.
For sure. I always lose my insurance paperwork, but I'm glad it's here.
Yeah. I mean, even if you have a property manager, they're not paying your mortgage necessarily. Sometimes they're not paying your insurance. They don't have everything. So even what they're reporting is only part of the picture. So it's nice to bring it all together.
Yeah.
Thanks for that, Devin. And Victor, should I head on over to the reports tab?
Yeah, let's go to reports next. So by default, we'll have you here on the net cash flow. As I mentioned, the dashboard is pro forma at the very top, but if you really want to go into the minutia of things, this is the best place to be. We have a couple filters there. Currently, you're looking at all properties for the last 12 months, filtered by month and by subcategory. If you scroll down a bit here, yeah, there should be a net cash flow, net operating income of the actuals.
There we go.
So you can see exactly what it is per month.
Mm-hmm.
And this is excluding CapEx.
Things are going the wrong direction, guys. It's I posted my rent too high, and then nobody wanted to rent my house, and I had more vacancy.
Yeah, so this is great to play in. I believe you should, if you see a charge in there, you should be able to click on one, and then it will take you straight to the transactions page by that category. And again, dives you deeper into the transactions page to see where exactly that expense came from.
Yes, repainted. Hey, that's did I hear you guys have like a tool, Brad? I know one of your like key points was like make sure you price your rentals correctly. Do you guys have any tools for that?
Yeah, there's a rent estimate feature.
Yeah, so we could actually, before we get to the rent estimate feature, I do want to show you the tax report. Since we were talking about taxes, at the very top right here, where you see net cash flow.
Okay, let's see.
Under report type.
Yeah,
There we go. So if you go ahead and click on that, we have a various amount of different types of reports, but the second to last one is the tax package. And this is, I think, David, you pulled one earlier. So this is easy, one email, and then you can forward that to your tax preparer.
Wow, this is awesome. I don't know that I pulled this specific report. I think I exported my transactions. So this would have been even better. I did not know about that.
Yeah, the best thing about this one is actually pulls all your receipts as well.
Yep.
So it sends it a zip file. And then one more report I want to highlight that we mentioned in the previous slides. If you click on report type again, at the very bottom is the stress test. So this model is going to show your portfolio cash reserves, and it's going to just estimate not occupancy, vacancy. There we go.
Oh, cool.
So I think it does take a little bit to load, but hopefully we get it going here in the next like 10 seconds or so. There it goes.
Oh, this is awesome.
Yeah.
Yeah, so this basically lets you dial in an expected rent collection percentage. So 100% would be, as expected. And you can dial it all the way down to 0 to see how sensitive your portfolio is to someone not paying rent.
So where do I see if it's okay or not? Where do I see if I'm going to be okay?
You zoom in there, you should be able to see other cash. So cash balance after 6 months. So this gives you a 6-month window of withstanding only 70% instead of 100% of rent collection. And then this math down at the bottom kind of shows you how your cash reserves will hold up under that scenario.
Yeah, total cash reserves down here.
So there's your total ending cash after 6 months. You can actually export this as an Excel file, and you can tweak that 70% directly, or you can just change it up top here in the dials.
Man, I'm blown away. This level of sophistication to somebody that has like 10 properties like me, like I don't have time to model it myself. The fact that this is available to me and for free is amazing. I seriously can't believe you guys offer all this. I didn't even know this was here, but this is really, really awesome.
Yeah, this one was a fun one for us to do because it's a more interactive model. So it's different from all our other reporting. And we came out with it literally, we had the idea right when COVID hit. We came out with this 2 or 3 weeks later because there was this sort of sense of panic that a bunch of tenants might not be able to pay rent, right? Fortunately, it didn't turn out to be that bad of a scenario, but it was for some people in some places.
Yeah, totally get that. And wow, this is awesome. Where else do we have to go, Victor?
Yeah, so let's go to the investor's guide. So go ahead and click on resources.
Okay.
And then investors guides. And this is where you'll find the tax guides Brad mentioned earlier, some more literature regarding anything investor-wise. We should have posted here.
They're
Love
very
it.
well written.
You do write very well, Brad. I'm always blown away by the emails.
And yeah, they should all be PDFs. So you should be able to click on them, download them, print them.
That's awesome. So somebody was asking, Stessa is amazing and provides a lot of value for free. How are you able to provide all this value for free?
So we do have some features that do have a cost, which will be the next step. If you hover over resources again, we do have the rent estimate there. That one does come at a fee.
Okay, let's do it. Let's see what happens. I want to do, this is an oddball property. Should I do an oddball property or should I do like a more standard property?
The only thing, David, I think you may need to put your credit card information in. So I don't know if you want to, if you want, you can click on click if you sample, make it a little easier.
Okay, there we go.
Yeah. So boom, that's one sample of a property. And it gives you, I want to say like 10 to 20 comps for a specific property in the area.
Oh, that's really cool.
Yeah. I would say, a couple other ways we're starting to monetize. We're working on insurance, mortgage referrals, because we have a lot of relevant data about various people's properties, right? We know what you're paying for insurance. We can make a very targeted offer based on what we're seeing other users paying for that same insurance, same type of property that hopefully saves you money. So that's one way we're going. And then we're also recently acquired by Roofstock. So we're part of the Roofstock portfolio. And they've got a very active marketplace for buying and selling turnkey tenant occupied properties. So there's some back and forth there as well. And that integration is very early, but it's off to a great start. And we're having a lot of fun working with them.
That's awesome and great to hear. Congratulations to you on the acquisition.
Yeah, thank you.
Thank you.
Cool. Victor, is there anything else we should cover?
Yeah, that's pretty much the main chunk of it. Again, recommending people to spend most of the time in the transactions, making sure everything's lined up correctly, running reports. You could run different date ranges just to see exactly what you're looking for. Either that, or if you do have specific questions, if anybody does start a Stessa account, if you click the little blue button on the right-hand corner, send a message, either myself or Devin, we're posted right there. We're not online right now, but we'll get back to you as soon as we can.
Love it. Man, thank you guys so much. Let's give it up for Stessa, everybody in the chat. Let us know what was like the number one thing you took away from the Stessa demo. Yeah, Corey loves the stress test. I personally didn't know that was available. That's amazing. Yeah, Austin, you need Stessa. Love the stress tools, comps. Let's see. Already added one of their properties to the website. Love it. Good job, Carl.
Nice.
And love that you can customize the graph on the dashboard. Yep, I didn't know that. That's a great feature to get the CapEx out of that graph. And the stress test. Somebody says, this looks like DealMachine. I did switch over to DealMachine. We're going to go ahead and give you guys, only if you want it. If you guys are interested, we can show you some of DealMachine at the end of this. But if you go or not, make sure you click the offer link for Stessa there that Matt's been posting in the chat. So let me know, guys. Do you guys want to see a demo of DealMachine or you want to call it a night?
I want to see it.
Okay.
Yeah, me too.
All right,
I'll stick
cool.
around.
Sounds like we'll do a demo. It sounds great. So again, Stessa is for optimizing and managing your rentals and keeping those finances in tip-top shape. That way you don't become a tired landlord. But if you want to buy properties from tired landlords, that's what you use DealMachine for. So DealMachine has a ton of acquisitions tools that we're going to walk you through. So the very first thing that you're going to see when you log into DealMachine is a dashboard that will help you budget for your marketing expenses. So I'm on the enterprise plan. The basic pro would be a little bit more simple, but let's say you want to create $10,000 of profit per month wholesaling houses. That is set up for wholesaling, but if you're acquiring rentals like me, it still works the same. And let's say in your market, the average wholesale deal may be like $5,000 spread per deal. Let's say you have a couple drivers. So this calculator will show you need to probably add about 600 leads per month driving for dollars, rundown houses, because DealMachine members average about one deal for every 300 leads they put into and market in Indiana. And then the goal for the driver should be add 75 properties per week. That'll probably take them 7 hours of weekly driving time because drivers typically add 12 properties per hour. Okay, so then you can factor in enterprise plans like $3,000 a year rather. The basic plan is $59 a month, just so you know. This is how much you'll spend on drivers. This is how much you'll spend on marketing, estimating 3 mailers per lead. So one of the biggest struggles, and again, this is for somebody who's got a budget, pretty big budget. If you're just looking for 1, 2, 3, 4 houses, you may do the basic or pro plan, and that dashboard is going to be a little bit more appropriate for that. But same idea, it's going to help you plan and have the right expectations for what you should be investing in marketing and how long it's going to take, et cetera. So if you go down here, we do these weekly webinars just like tonight, every Thursday. So you can sign up for the next one in your DealMachine account. And, based on my dashboard, I only needed 600 leads per month, but so far I've had 5,000 added. And I don't have any mailers active, and I have 66,000 active leads currently. And then this graph over here show you 4 different ways to look at your activity. So leads added, mailers sent. If you input your deal, it'll show you the profit and the total tech spend on mailers and the technology over time, and you can customize the graph there. So right now, I haven't been doing mailers the last 6 months because I've been doing text messaging only. But I see Brian is asking, how much per month do you spend on mailers? So great question, Brian. So mailers are 55 cents per mailer in DealMachine. And if you want one deal, we're seeing that it's 300 leads marketed like 3 times each. So that's 900 mailers times 55 cents would be your mail cost to do a deal. Hopefully that helps you out. If you're in California, I would say like 5X that, but your profit's also probably going to be 5X. So keep that in mind. Great question, Brian. So now let's take a look at the map. And if you're driving for dollars, that's one of the ways you can generate leads with DealMachine. The green is showing me all the routes that my drivers have driven. And I can see these are recent routes in the last 6 months, but if they're a little bit older, it'd be yellow. And if they were older routes, 12 to 24 months old, they would be red. So a lot of these routes are green, but I'm seeing some yellow here, which tells me that's kind of like an aging route. And if I'm noticing a lot of it's yellow, I would want to direct my drivers to go cover that area again, see if anything new happened that we might want to add a property because of. So the way to add a property, when you're actually like using your mobile app, it looks like this. Oops. Let me resize my window. Oh, that doesn't seem to be working for me on Chrome right now. When you're on your mobile app, you're using the mobile app, not your desktop. You end up clicking a property, and then you can see some basic information about it. It's owned by the Historic Landmarks Foundation. Probably don't want to add that one. Let's add another one. So you click it and then you press add lead. And from that standpoint, we could tell the owner is Thomas and Barbara Reed, and it is owner occupied. We did have a successful skip trace, found 7 phone numbers. Let's take a look at those. Okay, so first phone number, caller ID is Neely Michael. I don't recognize that. Reed and Co. Says same last name, so I bet that's their phone number. I'd probably call this Reed and Co. phone number because I'm seeing that the caller ID actually matches the owner name. So that's how I'd prioritize giving a call. You could also send a text message to the person right from DealMachine as well. Oops. If a driver redrives a route and adds a property that is already marked as return mail, will you be notified that it's already on the list? Yeah, so all my drivers, they don't see all of my leads, but if they are driving by a house that was already added, it wouldn't let them add it again. So we wouldn't be duplicating the efforts. That's one of the advantages of using technology to manage drivers out there looking for properties. Let's see, another useful feature is I want my drivers to focus on neighborhoods where the property values are above 50K, maybe like the 50K to 200K. So I actually have this highlighting properties feature. So I can highlight properties on the map that meet that criteria. Let's see, assess value would be the field we would want to set. So let's do 50 to 200. Let's bump it up a little bit. We're downtown, might be expensive. So I tell them, I want you to focus on streets where there's more green than not green. So when they're looking at the map, they're saying like, oh, all these are green. So this is a street I want to be on. So that's one way I use the highlight properties feature. But you could filter it by a lot of whatever your criteria is. You've got a lot of fields here that you could highlight. Gabriel, if you have a question, I see you're raising your hand, but if you type it in the chat, we can definitely answer it fairly quickly. What about the Stessa team? You guys have any feedback on what you're seeing so far?
I'm loving this. I wish you guys were in Canada.
Well, I would love to work in Canada too. I'm curious though. There's the key thing that makes our product work is like the public information.
Yeah, it's not available, publicly available here. You gotta pay for it, or it's gated.
Yeah, exactly.
The level of detail is really impressive. It's amazing how deep you can go on any particular address. And it seems to me this just becomes more and more important as deals get harder and harder to find, and MLS is really competitive and values are going up.
Yeah. Yeah.
How else are you going to find deals, right?
Yeah. Thanks, Devin. We've seen more people that they were buying from wholesalers, and nothing wrong with the way wholesalers are doing business. I mean, they're incentivized to sell it for as high as possible, and those hedge funds are willing to buy. But for like an independent investor, they're, instead of buying from wholesalers, they are trying to find their own deals too, direct to seller marketing. So we're seeing people shift over to DealMachine to do that.
Yeah, it's great.
This is a leads view. So it's any lead that you added on the map, like I showed. You can see here in a grid view format. And so you can quickly start a mail campaign. In fact, that's one thing I don't think I showed before. So outreach campaign with the mailers. You can click to see exactly what this would look like. You can customize your mail, which I will show you in a little bit. Let's see here. And you can, if you're driving for dollars, click the map instead of tags. You could tag what you notice about the property. So my drivers, they may wonder like, oh, what should I be looking for if they're new? And the tags is basically pre-populated with like anything that you'd want to look for. Biological growth, like mold on the side, it's vacant, fire damaged, tall grass, and all the tags and everything that you've seen so far is available in the lower price packages, except for you don't have extra drivers on the basic package. It's just for you, just for one person. Great questions. Keep the questions coming. Let's see here. So we have an ability to pull comps, not for rentals, but for purchase prices. So it looks like that one didn't have, let's see here. That's a tab on a property that you've got pulled up here that's available. And then you can edit the columns. So there's lots of data that you can move around and edit the way that they're showing in the order that they're showing in, if you prefer to view it a certain way. And then you can filter the leads in the same way that we highlighted properties on the map, such as one common way that I filter this by is, every week I meet with my drivers and I ask them, how many properties did you add? But then I kind of check in real time and I spot check the pictures. I'm like, hey, this property looks pretty new. Why'd you add this one? And we kind of address if they're not adding the right kind of properties on a weekly basis. We just kind of spot check and review that way. So that is one way that I use the filtering on a regular basis. All right. So their routes are tracked. So I can see exactly where everyone drove. And again, they're supposed to do about 20 to 40 hours per week. And the way that I asked them, but then I also double check here real quick to make sure, and I have to change my time frame here to be 1 week. But then I can see that Martin drove 12 hours this week. So it's not within our agreement. So I would want to ask Martin, was there anything that came up that prevented you from driving a full 20 hours? If there wasn't, then we talk about, well, okay, if there's, if you can't do the 20 hours, I need you to let me know. Otherwise that's going to be a problem. And that's work that weekly meeting has really helped to eliminate any issues. You kind of catch them quickly when you meet that frequently with them. So let's see here. Okay, let's talk about mailers. So the first part of a mailer is your signature. It's like your return address. It's your photo, it's your phone number, it's your email, it's your website. And if you're a realtor, you can even put your disclosure. So once you set up your signature, you might want to have two signatures if you invest in two different cities. You want the local address to be going to that property. Then you can have fun with mail templates. So we've got 10 templates that are done for you. And you can change the colors, you can change the font, and you can even send one that was written by a robot holding an actual ballpoint pen. And so that is available as well. But let's look at one of these regular templates real quick here. 4x6 postcard. Here's what you change, what it says and the colors that it is. And then you can preview it and see what it looks like. And then of course that ballpoint letter, ballpoint pen envelope. Let's take a look at that. This is a generated preview, but is actually written with a machine that holds a pen. So it looks very personal. So that's what you're getting with the ballpoint pen. Okay, so usually you can just repeat the same postcard. I usually every 21 days. But if you want to get more sophisticated, we also have campaigns, which lets you send postcard A followed by postcard B, and then 3 ballpoint letters, whatever it is that you want. You can customize those yourself. And this is how you do it with the campaign builder. You basically just select which template and how many times you want it to send and how frequently. And that's how you would build a mail campaign. Cool. Once you have all your mail scheduled, you might want to know well, if I have all these things repeating every 21 days, when are they going to repeat? How much is it going to cost? So that's when the mail calendar would be really beneficial. You can see what was recently sent, what's scheduled, when it's going to send, and then the estimated cost for, this period of time. So if you're using mailers, the calendar will be very helpful for you. Okay, moving right along to lists. Let's see here. What does the dollar amount beneath the profile picture mean? Was that on the calendar? Do you know what he's talking about, Matt?
The
or
deal
Adrian?
credits.
I think your top left. under your
Oh,
name.
there we go.
Deal credits.
Yeah. Okay. Yeah. So we have this thing called deal credit. I mean, a deal credit is $1, but it's used for sending mail or skip tracing. The reason why your account can carry a balance is because you don't want your credit card charged 55 cents every time you send a mailer, because then your credit card statement would be really, really, really long. And so you can just add credits in bigger increments to your account. And then you can also have it auto reload, every $500 or whatever that you spend. Okay, so we talked about driving for dollars, but if you want to get leads faster and you've got a little bit bigger budget, you might just want to pull some leads. So this is our list builder, and you can start with a zip code, a city, or just draw an area. I like to draw. That's fun. So I'm drawing around Shelbyville, Indiana. And then I could say, show me all the properties, or maybe just the vacant properties. It says there's 153. Maybe I want to target owners of multiple properties and advertise, say, hey, do you guys want to join my buyers list? You can do that. Pre-foreclosures, bank owned, absentee owners. And then you can further customize any way you want. And then add this to your DealMachine account. And then a smart list would actually synchronize this set of criteria, and it would turn your marketing off if the house no longer meets that criteria. Let's say it was recently sold. You wouldn't want to market to it. So that's what the smart list does. And you can sync the smart list to your marketing if you want to automate that. Okay, messages is the text message system that I told you about. So you can actually, we have a system that lets you get in contact with those homeowners to see if they're interested in selling. And so this is where you would go to follow up with all those messages in one spot. The team is where you invite other individuals to your account. You can give them 3 levels of access. And you can even say, can they do this? Can they not do this? So you can give them the exact access that you want. The team feature is, though, part of the professional or the bigger plan, enterprise plan. And then you can also choose to give someone access to different plans, the driving for dollars, the list builder, the SMS marketing plan. You can give or remove access to somebody for any of those. Let's see. Get free leads. That's just like a promo code that you can share, and you both get $5 of credit if they sign up. The settings, you can do stuff like change your email, your subscriptions, your add-ons that you have. You can change some default mailing options. You can use it in dark mode. We have street pick, which if you don't take the photo, you can actually grab the Google photo and put that on your mail. This one's pretty helpful. Whenever you first get in your car, what app screen do you want it to show you when you pull open the DealMachine app? So if you're driving for dollars a lot, definitely would want to click this to be the map. That would be the best place you'd want your DealMachine to start, but you can set that feature there. And then, yeah, you can import a spreadsheet from here as well, or set up Zapier to integrate with other technologies. We got a feature request page that we listen to, and you can see like the top things are checked off. We're under consideration for some other stuff. This thing has over 400 ideas. If you've got something you want us to build next, find it here and vote on it, or submit a new idea. And then last but not least, we got the support for you. And we've also got some instructional videos and training material. These are actually live training classes that you can take And the link to that is right there in your DealMachine account. The instructional videos are on our YouTube channel. So we are here to help you guys acquire more deals. So feel free to reach out and take advantage of those things if you have a DealMachine account. And that concludes the DealMachine demo. Hope you guys really enjoyed it. Matt or AJ, did you guys find anything that I left off, or maybe I went too fast on?
No, I think that we had one question a little while ago on deciding which market to start, marketing campaigns to wholesale in.
Okay.
Do you have any advice there on choosing a specific market or a neighborhood?
Yeah. So I'm guessing the person is like in California. For me, it was Indiana. I mean, everybody comes here to invest in rental properties. So that was very easy for me to decide to do that. You can wholesale anywhere. It's just like a pawn shop business model. You're providing speed and convenience, and they're providing you a discounted price. The only downside to like starting in a place like California is it's going to cost you a lot more to get started. Because the deal size in California is so large, you're going to make a bigger profit than you would here wholesaling, but you're also going to have to invest more in marketing to get that first deal. So probably like 5 times more, I would say. So it's just up to you. If you've got the budget that can support that, instead of $900 or 900 postcards. Yeah. Instead of like $900 here, you'd probably be spending like $5,000 to get a deal out in California. Or more. Great, Matt.
You want to make sure you have enough local knowledge as well. You don't want to just randomly pick a market that you know very little about unless you plan on becoming an expert, because there's a lot of nuances, as Devin said earlier. Everything is market specific, so you want to make sure that you know what you're doing in that particular market as well.
Brad, I wanted to ask you, how do you actually acquire deals? Are you looking at MLS listings, or do you go direct to seller?
We go direct to seller, and I'm just salivating at some of these features because none of these are currently available here, but I would definitely use this because I do a MacGyver version of what DealMachine pulls together. I'll do zoning searches, I'll do title searches to see who owns the property. I will try and find someone to do that approach. And typically it has to be a physical approach where you go knock on the door versus, text message or mailer. So that's typically how we do that. And it gets easier. The bigger your network becomes, the more investors you talk to, the more brokers you talk to, they know the kind of properties you're interested in. So I've found networking has done wonders for me to find off market deals.
That's awesome. Well, guys, thank you so much for joining. There's my contact info if you guys want to get in touch about DealMachine. Matt, do you have anything for the Stessa guys? Oh, there we go. All right, guys, here's the Stessa. Here's how you connect to Stessa for the stress-free stress test. That's a tongue twister.
Catchy. I like it.
Thank you guys so much. Guys, let's share some love. Let's show some love to Stessa in the chat. If you guys got some value out of this webinar, really appreciate you guys taking this time out of your Thursday evening to be with us.
And thanks for hosting, guys. Really appreciate it. This was a lot of fun.
It was for me too. Glad to hear you.
Thanks for coming on.
Thank you for having us. It's great.
All right, guys. I will see you next time. Signing off. And what is it we say? Happy deal finding. I almost got, I was wondering if that was our tagline. That is our tagline. Does Stessa have a tagline?
I don't know that we have a real snappy one. Does anyone know where the name comes from? You can see it in the name if you're creative.
So is there somebody named Tessa?
No. Oh, somebody got it in the
My
the
daughter's
chat.
name.
Assets. Oh, wow.
Dalton got it.
Nice.
That's amazing.
Good work, Dalton. He gets a prize.
If we had to come up with a tagline, it'd be everything in one place.
Yeah. All right, guys. Happy deal finding and enjoy everything in one place with your new free Stessa account. We will see you next time. Thanks, guys.
Cheers.
Thank
Bye,
you.
everyone.
See ya.